We have the dividend yield as a buy criteria. So we are looking at companies which provide a certain dividend yield to us. This makes us generally contrarian investors. So we buy those parts of the market which have been neglected and sit at better valuations, i.e. higher dividend yields, and we sell those parts of the market which are overloved and come at higher valuations or lower dividend yields, if you want. So if we look at the current portfolio with regard to the sector positioning, I think the most prominent examples are we are overweight the energy sector, which we think has been lagging the market despite a very positive development of the oil price. So there is more potential here. And we are also overweight the financial sector. The financial sector, for example, also gives us a good leverage to rising interest rates. When we look at the portfolio with regard to the country positioning, the most striking example probably is our overweight in the UK, which on first sight might be a bit counterintuitive because the general opinion is that the economy in the UK will do less well, and we would agree to this in general, but because we are stock pickers, there are some interesting opportunities in the UK. There seems to be a discount being applied due to this more gloomy outlook for the UK economy to all of the UK stocks. So when we can find good companies, we can buy them at interesting valuations. So when you look at our portfolio, you might be surprised to actually find, for example, a high street fashion retailer in our portfolio, despite the fact that the UK consumer has been doing less well. But if you look at the company's specific situation, this company has been doing particularly good, and because it comes at a very nice valuation, we're happy buyers. I think the attractiveness for dividend stocks and dividend-oriented strategies at this point of time go back to this observation that markets probably become more difficult to navigate. So you don't probably want to go at full speed going forward. The outlook as such still is a positive one, so we still expect very decent returns for European equities, but you probably want to take it a bit more carefully, and dividend-oriented stocks can be the right measure for this because they provide these high dividend yields, these dividend payments. They have a certain anchor and they can help to buffer some of the market fluctuations. So if we see some return of volatility, which, as I mentioned before, due to the monetary policy, the change in monetary policy is a fair assumption, then dividend stocks can help to buffer some of these effects. So we would think at this point of time, dividend stocks are actually quite an attractive way to keep the upside for European equities, but also buffer some of the downside if the going gets tough. A balanced portfolio will help to mitigate the volatility of markets even further. So if an investor is not prepared to take the full risk of equities in the sense of absolute risk, volatility, then a balanced solution which adds other asset classes to the mix and brings down the absolute risk can still keep a certain degree of the upside, the attractiveness of European markets, European equity markets in particular, but at the same time mitigate some of the risk.